Welcome, everybody. I just want to chat. Here we got our market update for the Southern California housing market for May 18th, 2020. And I'm going to take just a couple of minutes at the very beginning. By the way, I'm trying sitting a little bit farther back. Someone emailed me and let me know that they watch my videos on their big screen TV on YouTube, which means my head is about 2 feet around. And that's kind of a scary thought. So I thought I'd sit a little bit farther back. I had something amazing happen this weekend, and that is someone that I've known for a while approached me and made the comment, I think prices are slipping in my neighborhood. And they identified that they had seen a couple of houses that came up for sale for lower list prices than they expected. And that really made me think about something important, and that is, how do you know when your data is good and when you are getting crappy data? What's sort of an easy way to know? Because obviously our market statistics aren't really showing a slipping market at the moment. So I'm going to just kind of nerd out for just a couple of minutes because I think this is really important. If you were to go look at stats for your neighborhood on a week-to-week basis, they will be wrong. Actually, let me correct that. They may or may not be wrong, but they will be very unreliable. And the reason why they will be unreliable is sample size. And just to check and see if anybody's listening here, if you have heard the term sample size, go ahead and write sample size in the comments to this video. If you do that, I will enter you in a drawing, and I'm going to randomly pick, and I will send a $20 Starbucks. Actually, I'll send two $10 Starbucks gift. So we'll do two. To people if you just write sample size in the comments. And the reason why sample size is important is because there's a lot of randomness in real estate. And if you don't have enough data, these random peaks can sort of screw up your conclusions, and they could be wrong conclusions, and you wouldn't necessarily even know that. So when we're looking to comprise market stats, like about the Southern California housing market, for example, there's really a couple things that we can divide and slice the data by. So the first thing we can slice the data by is geographic location, right? So right now we run a geographic area, and there's actually a really good reason why we do that. The second way you can slice and dice the data is by property type. And we do that a little bit, right? So we say above $1 million and we say below $1 million. But we could also say, single family homes between 12 and 1,500 square feet, right? I mean, we could narrow down that property type. And then the final way that we sort of divide our data up is by time, right? A period of time. So I could say, for the first 3 months of the year, or the last 3 months, that's a much bigger data set than the last week, which is what we've been doing. Because our market is moving so quickly, I think it is very important to have weekly data. I would rather have data that is specific by week than data that is specific by geographic area. And the reason being is, frankly, for the most part, Southern California is a very contiguous market. So it's rare that you would find, say, booming property values in LA and crashing property values in Orange County. It just, aside from weird events, that just tends to not really happen because these areas are economically tied together. And then, by dividing the housing type, what I love to do, say entry-level single-family homes and condos and break those out, of course I would, but I don't feel like there's enough data to do that, because if we slice and dice our data too much, we end up getting very unreliable results when your sample size is not big enough. And I've prepared some slides as per my custom to kind of show you that. So this is pretty fun here. I'm sharing the screen here. So this person who contacted me over the weekend, I promise there is a point here and I'm leading you to it, asked me about Rancho Santa Margarita. And I said, well, they asked about condos, but I felt like that market was even way too small. So I said, let's do single family homes, right? And so we did kind of a stat that we normally run. We've got May 2nd through May 8th. There were 12 new escrows, and the average price was $900,725, and the average days on market was 41. Then we ran the next week, which was May 9th through May 15th. 9 new escrows, so that's actually a drop of 25%. And look what happened to our average price it went from 900,000 and change to $823,000. So that is, that is roughly a $77,000 drop in average price, or honestly, like just shy of 10%. I mean, this is huge. These numbers are big. Sales down 25%, average price down, nearly 10%. Oh my God, the sky is falling. But this information is unreliable, and I'm going to show you why and show you the complete story here in just a second. And here we go. Now we've got the complete story. You'll see we've added a couple of columns on there. We have our average lot size and our average square footage. I'm going to take you to the square footage first. So 2 weeks ago, we were talking about an average square footage of 2,400 square feet. And this week, we were talking about an average square footage of 1,900 square feet. So nearly a 500 square foot difference in the average new escrow between those two periods of time. We are comparing apples to oranges. So of course, you would expect the price to be significantly less when the houses are significantly smaller and the lot size is significantly smaller. And we're not even talking about condition differences, right? Which we don't have a quantitative way to measure. So, when you look at these stats, you can see sort of the folly and the danger in being too specific. If you slice up your data too much, you get data that is horrifically unreliable. And this doesn't mean that prices are not dropping in Rancho Santa Margarita single family homes. They could be, but we couldn't tell that from this data. It is unreliable data. So when we put our stats together, part of the reason why we do it the way we do it is to ensure that we get accurate data and that we have a sample size that actually works for us. So I'm going to go ahead and jump into this, our normal presentation here to kind of give you an update on what's going on. Go through here. So we've got our new listings, and you'll notice on the right-hand side here, I've kind of relabeled things, right? This is the week starting with that date, and we've got pre-stay-at-home, post-stay-at-home, and then sort of the weeks. And you'll notice, guess what? We had a jump right through here. You'll see a pretty solid jump in new listings, and that happened both under $1 million and over $1 million. Hardly surprising. I think the word is out that the market is pretty strong, and a bunch of people who've been waiting to put their house on the market have gone ahead and done so. There is another reason that I'm going to talk about before I switch to the next graph, because I think it is really, really important. Our MLS recently adopted a rule change where they allow a new type of thing called a coming soon. And a coming soon listing does not show up on Zillow. It does not show up on Redfin. Days on market does not accumulate, and nobody can go see the property. However, it does show up in the MLS as a new listing registration. So these coming soons, which may be up to 3 weeks from actually hitting the big public market, those coming soons count under our new listing stat. So, okay, we're going to jump back in. This will be an important detail in a couple minutes. So stay with me. So if we go here to new escrows, we actually see that that has pretty much stayed the same versus last week. It's actually dropped ever so slightly. And for over $1 million, it's gone up just a little bit. So we're kind of in a little bit of a holding pattern of new escrows. We're still way off our pace, but also we haven't dropped through the floor either. And we're still stronger than we were immediately after the stay-at-home order. I know a lot of new things are opening this week. We got news from the governor today. So, I will be very interested in seeing what tomorrow's stats are going to bring us. But now let's go on to our absorption rate. And we kind of have an interesting story here. You'll see that we dropped significantly versus last week in both categories on our absorption rate. And if you look, we're hovering just above 60% for our under $1 million sort of demarcation. And if we go here to our historical data from 2019, we should be in those low 70s if we were matching last year. And in fact, we were doing really well last week. So the question is, what happened? And here I'm gonna take a step back and remember that coming soon thing that I talked about. When you think about it, coming soon listings are really active listings that aren't going to really be active for a couple of weeks. So we're seeing these a little bit early. And in fact, Since they have rolled out this coming soon, which just rolled out in the beginning of May, at first no agents were doing it, and now we're seeing a ton of these coming soon. So of the 1,440 new listings in the past week in our market area, 140 of those were actually coming soon, meaning you will not see them on Zillow, you will not see them on Redfin. So, one of the issues that we have is this is a weird transition period, right? Because in a couple weeks, these are ones that won't get double counted as new actives. So they will not be in the stats 2 weeks from now. So I think we're going to see that this absorption rate is going to kind of bounce back to normal in the next couple weeks. I think that's my sort of prediction of what is happening with that. Also, I think when you think about these absorption rates, one of the things we're noticing is there seems to be a little bit of a timing issue. And what I mean by that is we are counting sellers and buyers are operating on slightly different time schedules. So in the end, this all evens out, but it means that in this week-to-week data, we can have a little bit of jumping around like this, especially if there's a week that's, there might be, this week might have been the strong listing week. Last week was the strong week for new escrows. So these might not exactly be on the same time schedule. And I think that's really important to sort of understand that and kind of bear that in mind. So this is one of those things where we like to see absorption rates higher than this, but we really need to kind of look at some of the other data and see, does that support a very dangerous trend, or is this just kind of an outlier because of timing issues? And we can kind of weigh that and decide what we think. Moving on our data here. So this is our average pending list price, and we've talked about this a couple times before. And I like this statistic because this statistic tells me about properties that went into escrow last week. This means buyers who actually negotiated with a seller in the last week and came to an agreement. And if you notice, I'm going to get out my little annotation thing here. If you notice, back pre-stay at home, we were at 612-ish. We dropped immediately. We dropped a little bit more. And we started to kind of rebound. And then the last 2 weeks, we've seen an upward trend. And actually, we are about 0.5% higher than where we started. And one of the things, if you look at this chart, I think what this chart really tells us is just how steady our pricing market is. I will say we are seeing a little bit of an upward trend in prices. I think at this point, I'm comfortable saying that because, we saw a pretty significant drop and a reversal of that, or not significant drop, but enough to be noted. I think at the most we went from 612 to 597. That's approximately a 2% drop there if we're talking about our math, and we have completely rebounded from that. So I think there's enough of a trend here to say that our market is steady with a slight positive increase in pricing. So we've had great interest rates. I think there's a lot of reasons for that. I'm, of course, as always, curious to see what the next week will bring, so we can add another bar here and have a little bit more trending on this front. We're also going to show you here, this is our million plus. And, you'll notice I haven't been talking about our million plus numbers because, frankly, I'm not really very happy with how I've set this up. At the beginning, I talked about sample size, and there's something called sample homogeneity. And that means, how consistent are your samples from week to week? And I think the problem is in the million plus range, we didn't put a cap on this. In hindsight, if I were to redo all of these numbers, I think I would do $1 to $2 million and leave it at that. Unfortunately, I don't have a time machine, and I'm also not sure whether I want to go back and redo all that data. I don't know how useful that would be. What we might do is just start doing a rolling change going forward, that instead of a million plus, we're 1 to 2 million. I think that'll make these numbers a whole lot more meaningful when we're talking about that. One other thing, before I go on to kind of our last slide, which is our days on market calculation, to kind of summarize where we are, I think, our pricing isn't slipping. It doesn't show that. So even though our absorption rate is looking a little funky, I think this coming soon status is kind of throwing a monkey wrench into that statistic, at least right now. Within the next couple of weeks, I predict that should smooth out and even out a little bit. But for now, that's looking a little funky. Our pricing doesn't seem to indicate that. And then let me pull up our days on market, which is yet sort of another piece of data that we use, right? When properties start sitting longer, that means that they are more likely to see price drops. And in fact, if anything, if you look here, in we are seeing pretty strong, and by strong I mean low days on market numbers. We are hovering right in the high 20s, or I think we might be right low 30s. But these numbers are great for under $1 million, and even our numbers here for over $1 million. Now, one of the things I tell people is, if you read the title of this chart, it is days on market for new escrows. What I care about is the properties that buyers are actually buying, not the property that has been overpriced and sitting on the market for 6 months. That data is not terribly useful for me. I want to know about the properties where a buyer and a seller are coming to an agreement. That is the information that is the most important to us. And as you can see here, these numbers are very strong. We're still below where we were at pre-stay-at-home order. And I think, and none of these numbers has increased, up to 60 days on market. We haven't seen that kind of an inventory languishing bump. And I think until we start seeing that, we're really not going to see huge changes in price. I think that's sort of your indicator that there might be a big problem on the pricing horizon and that prices might be dropping. So, in order to conclude here, let's talk about what this means if you're a buyer, what this means if you're somebody who's thinking about selling, and then I'm going to talk about what this means if you're somebody who's doing both. So if you're a buyer in this marketplace, I think if you were hoping for kind of a crazy situation where you would get some sort of great deal, I just don't see that happening. I don't really see it coming. I could be wrong, things could change, but we're starting to notice, and this is a bit of a hunch, so forgive me, and consider this with what you're paying for it, which is not very much. But I'm noticing that our level of new escrows seems to correlate with sort of overall consumer confidence. So, for example, this past week has been a little bit tougher with some of the numbers related to COVID-19. However, today we got news from the governor here in California that a lot more counties are going to be reopening. We also got some very promising vaccine news today as well, and some very promising antibody treatment news. So I think these things really sort of bolster up confidence to people and confidence in the future. And I think that will make a very big difference in sort of our escrows. If somebody was on the fence last week, they might not be on the fence this week. They're definitely a go this week. So I'm going to be really interested to see if, kind of that prediction of mine comes true. So I think if you're a buyer, the good thing you've got going for you is you do have new properties coming up onto the market. And I think you've got some choice and you've got great interest rates. So if you're a buyer and you feel like you have a pretty good handle on job security, I think now's a very good time for you to be buying. I think next week we might doing some affordability calculations to kind of track that as well, because I think that's really important if you are a buyer entering the market. If you are a seller, a couple things going on for you. New listings jumped. And I think what's cool about coming soons is that they are telling us how many actives we're going to have in the next couple of weeks. So it's kind of like a preview of actives coming. It's the spring. People are popping their houses on the market. I think your discussion is very individualized in a sense that if you live in a neighborhood or you have a unique property and you don't have much competition, by all means, now's a good time. I can tell you that the market is strong for you right now. I don't know what's going to happen in the future. The future is always uncertain. But I think if you were thinking about going now, you're in a good spot. If you are a buyer and a seller, someone who's selling one and buying another, I think for you, the big driver really is that you've got a healthy market and you also have low interest rates. And while, the healthy market thing is interesting because even if it becomes a seller's market, that means that you're going to get more for your house, but you're going to have to spend more on the house you buy. If it's a buyer's market, you're going to get a great price on what you're buying, but it's going to be harder to sell your house. So it's kind of a wash. What isn't a wash are interest rates though. And when those are good, you've locked that rate in for 30 years. Anyhow, as always, we love your questions. We love your comments. And as I mentioned, Well, if you were listening this whole time, you know we have a special offer for you. And if you go ahead and do that in the comments, you will be eligible. We'll probably take the drawing here in a couple days. Anyhow, if there's anything else, if you guys need anything, Stephen Mead with Domicile Real Estate, you see there in the corner, giving you information to help you make better real estate decisions. We'll see you next week.